Welcome to the NiftyNoon podcast. We've got quite a stack of recent daily updates here from our newsletter, the NiftyNoon Daily NFT Update. And our mission today is pretty clear. Take a real deep dive into these headlines. We want to pull out the most important stuff happening across the whole digital asset world for you.
Yeah, exactly. It's not just about reading the titles, is it? It's about figuring out what actually matters, separating the signal from all the noise out there. And this stack, it really covers the gamut. Everything from those super speculative NFT projects flying high, all the way to the big deliberate moves by TradFi institutions. And maybe most importantly, those kind of scary government regulation threats looming. It really gives a full picture, forces colliding.
Okay, so let's give you the quick TLDR, the main takeaways right up front. We're hitting 5 big themes. First up, Grayscale. They seem to be cracking the code on getting actual yield out of Ethereum ETFs. That's pretty new. Second, and this is a big one, that regulatory uncertainty. Like, is the U.S. government really about to rug DeFi? Big question mark there. Third, you've got the old guard, the conservative finance giants, specifically Vanguard. Are they finally going to have to give in and accept crypto? Lots of pressure there. Fourth, we're seeing serious money, TradFi money, pouring into prediction markets, places like Polymarket. And finally, just that raw energy, the crazy speculation, perfectly captured by something like the Hypur NFT airdrop going nuts, shows retail is still playing hard.
And when you line all those updates up together, what you see is a system under intense pressure, but also innovating like crazy. You've got institutions finding these complex, compliant ways to earn yield, while the very foundation, DeFi itself, is potentially facing a crackdown. So we're going to try and connect those dots for you, make sense of these seemingly opposite forces, and figure out where the real risk and reward might be today.
Okay, let's unpack all that. And maybe it makes sense to start where a lot of the raw energy often comes from, right? The really fast-moving speculative edge of the market. Our newsletter had a headline recently that definitely screamed frenzy. Hypur NFT airdrop goes parabolic, saying...
Yeah, that title pretty much says it all, doesn't it? Parabolic.
Yeah.
In crypto language, that just means, exponential growth. Straight up, often, frankly, unsustainable growth. It's that instant signal of a massive pump, huge volume, price just rocketing after an airdrop for this Hypur NFT project.
Right. And those little emojis, the water droplets, the cat, the chart going up, it tells you this is fast, it's high momentum, probably pure speculation driving it. But okay, why should you, listening, care about one specific NFT drop when we're talking about giants like Vanguard and Grayscale potentially making moves?
Well, it's actually a really critical signal. It tells you about the market's liquidity, its appetite for risk. See, if these little micro markets where it's mostly retail traders and maybe smaller funds, if they suddenly stop seeing these crazy parabolic moves, that could signal a much bigger pullback of speculative money. So think of Hypur maybe as like the canary in the coal mine for liquidity. It proves that even with all the big picture worries, interest rates, regulation, all that, there's still a ton of cash sitting on the sidelines, ready to jump on high return bets in things like digital collectibles. That excitement often starts right there at that level. And eventually that enthusiasm can kind of filter upwards, helping support the larger assets too.
Gotcha. So the foundation, the sort of grassroots excitement, is still being built by these really fast retail plays. But if that kind of speculation is inherently unstable, where are the big players looking? The cautious money looking for something more solid, maybe some alpha. And that takes us right into the next theme, the growing and sometimes kind of weird overlap between traditional finance, TradFi, and the crypto world.
Oh, it's undeniable now. The lines are blurring. Wall Street and Web3 are really starting to mesh. And we're not just talking about the early adopter hedge funds anymore. Now it's like major asset managers, big institutions starting to behave in crypto native ways.
Yeah, and this next headline we pulled really speaks to that strange mix. TradFi apes into Polymarket SOA. Okay, TradFi we know, but apes into, that's crypto slang, right? Meaning jumping in hard, fast, maybe without all the usual homework. Why use that term for institutions? And why Polymarket? It's kind of ironic, isn't it? Because traditional finance is all about slow, careful due diligence. Aping in is like the exact opposite. So when we see that phrase applied to institutions going into Polymarket, it tells us a couple of things. First, it suggests these TradFi players think the potential gains, the alpha from these decentralized prediction markets is just too big to pass up. They have to be there. Second, and this is maybe the more crucial technical point, it means they're putting their trust in smart contracts. Decentralized code running itself, managing potentially high-stakes financial bets.
Wow. So instead of relying on human brokers or centralized platforms, they're trusting permissionless, on-chain systems. That handshake and crystal ball emoji, it really does capture that blend, doesn't it? Old money meets future predicting tech. What are they actually betting on there?
Elections. Fed
Yeah.
moves.
Exactly. All of the above, potentially. They want those immediate, transparent results that a decentralized platform can offer, results that can't be easily tampered with. And they're putting institutional level capital behind it. It really shows that for some of these sophisticated players, the skepticism about decentralization itself might be fading a bit. It's being replaced by this hunger for better information, better returns. They're actually building financial strategies around outcomes secured by cryptography.
Huh. Proof that big money is actively hunting for an edge in these new crypto-native spaces. And they're even willing to adopt the language, the speed of the crypto community to do it. But if they're aping in there, they must also be looking at the really big institutions they usually deal with.
Which brings us to the elephant in the room. A headline about institutional acceptance that could literally move trillions. Will Vanguard bend the knee to cryptos? Yeah, this one. This headline carries serious weight. Vanguard is basically synonymous with conservative investing, passive index funds. They built this multi-trillion-dollar empire on low-cost, low-risk, diversified portfolios. And historically, they very actively steered clear of volatile stuff like Bitcoin, that orange circle, clearly hinting at BTC. So the crown emoji, the phrase bend the knee, it suggests this isn't just about adding a new product. It's like an institutional surrender, a fundamental shift away from decades of playing it safe.
Oh, okay, but for the listener, why does Vanguard potentially getting involved matter so much more than, say, another big investment bank launching a Bitcoin ETF? We've seen a few of those already.
It's the sheer scale, and it's the philosophical U-turn. Vanguard manages trillions in assets, mostly for retirement accounts, passive funds. If Vanguard were to just allow Bitcoin exposure, even if only a tiny fraction of their assets, like say 1%, float into Bitcoin, that alone is tens, maybe hundreds of billions of dollars floating into the market. Plus, it would instantly de-risk Bitcoin for millions of everyday investors who implicitly trust the Vanguard brand. It signals that crypto isn't just some fringe thing anymore. It's potentially a legitimate long-term asset class, suitable even for your retirement savings. The market's kind of holding its breath, waiting for that one massive domino to fall. It would signal the institutional floodgates are well and truly open.
But hang on, if Vanguard does bend the knee, isn't that a massive contradiction? They're known for avoiding speculation, for focusing on assets that generate income, not just price appreciation. Are they just sacrificing their principles to keep up with BlackRock and others who already offer crypto?
That tension is exactly the point. They're under immense pressure. It's almost existential for them. If all their main competitors are offering regulated, attractive crypto products, Vanguard risks losing clients who want that diversification. So their move, if it comes, probably won't be driven by any sudden belief in crypto's potential. It'll likely be driven by competitive necessity, by the realization that their old-school conservative stance might actually be becoming a business risk in this changing landscape. They're basically being forced to figure out how to repackage this volatile asset into something that fits their mold, something compliant, something risk-managed, or at least appearing that way.
And that leads us perfectly into how institutions are actually creating these compliant, risk-managed products. Let's shift from just talking about acceptance to the actual mechanics they're using, which brings us to Grayscale's latest move. Grayscale unlocks ETH ETF yield.
Right, this is where things get technically interesting and where regulation really comes into play. See, normally an ETF just tracks the price of the underlying asset, simple spot exposure. But Ethereum, unlike Bitcoin, can actually generate yield through staking. And Grayscale seems to be figuring out a way to capture that return the yield, hence the stake emoji, and actually build it into the ETF itself.
How do they do that? I mean, how does a big fund manager under the SEC's watchful eye actually get yield inside an ETF without making it some super complex derivative that regulators would hate? Our audience will want the specifics here.
It definitely requires some careful navigation of the rules. That word unlocks suggests they're probably using very specific, highly compliant methods for staking, or maybe even restaking the underlying ETH. Methods that don't break any custody regulations. It can involve, say, using only regulated custodians to do the actual staking. And then the rewards generated from that staking get distributed as part of the ETF's total return, kind of separate from the gains you get if the price of ETH goes up. Now, why is this so important? Because it transforms an ETH ETF from just a speculative bet on price into something that actually generates a cash flow. And that is what big institutional treasuries, conservative family offices, what they often demand. It's the kind of mechanism that could make potential acceptance by someone like Vanguard actually make financial sense for them and their clients.
Okay, so Grayscale is essentially building the financial plumbing that these big institutions need. They're taking this volatile crypto native thing, ETH, stripping out the operational headaches and the scary counterparty risks, and wrapping it up in a package that looks and feels like traditional finance. That innovation seems absolutely key to bringing in those more cautious institutional dollars we were just talking about.
Exactly. It connects directly back to the Vanguard point. Institutions want the potential upside of crypto and DeFi, but generally speaking, they only want it if these big regulated players can somehow legally sanitize it, de-risk it for them.
Okay.
But, and this is a huge but, this whole push towards creating regulated compliant yield exists in stark contrast to our final and maybe the most critical theme today.
Right. Because while the institutions are busy building these regulated on-ramps, the government is still deciding what to do about the underlying tech itself. And that final crucial headline in our stack hits that existential risk head-on. Is the U.S. government about to rug DeFi?
Yeah, this headline really captures the anxiety that's just hanging over the entire decentralized finance world. Applying the term rug pull, usually used for scammy crypto projects to the government itself, that column emoji, well, it signifies this deep fear of sudden, heavy-handed regulation that could just crush the market. This is the polar opposite of Grayscale, finding compliant workarounds. This is the fear that the very idea of permissionless finance, the core of DeFi, could be declared illegal or just made practically impossible to operate overnight.
Okay. When people talk about a potential regulatory rug pull on DeFi, what are the specific fears? What are developers and protocols actually worried might happen? Is it just like more fines or something more fundamental?
The fear is very specific, actually. And this is where we just report what the concerns are, trying to be impartial. There seem to be three main worries floating around. First, the big one, the Howey test. The fear is that regulators could broadly classify many core DeFi tokens, maybe even governance tokens, as unregistered securities. If that happened globally or in major jurisdictions, most existing protocols would instantly be out of compliance. Huge problem. Second, really strict rules around stablecoins, regulations that might limit what kind of assets can back them or put heavy restrictions on how decentralized stablecoins can even function. And third, maybe the most challenging technically and philosophically, rules that demand KYC, know your customer, and AML anti-money laundering checks be built directly into the smart contracts themselves, which kind of goes against the whole point of permissionless DeFi for many people.
Wow. Okay, so that's the fundamental tension laid bare, isn't it? You have institutions clamoring for yield derived from these systems, while the government is simultaneously debating whether the core technology, in its current decentralized form, should even be allowed to exist. That scales of justice emoji really sums it up. The outcome of these regulatory fights is going to massively impact the market's direction.
Absolutely. These sources, read together, really force you to grapple with that split. You've got retail chasing those parabolic gains in NFTs like Hypurr. You have institutions demanding yield, but only if it's squeaky clean and compliant, like what Grayscale is building. And then you have the government potentially ready to bring down the hammer on the whole permissionless foundation. The market isn't just reacting to simple supply and demand anymore. It feels like it's constantly trying to price in this huge weight of political and legal uncertainty.
So looking back at these 5 updates, it really feels like the market is trying to be 2 completely different things at the exact same time. It's trying to be this wild, speculative casino on one hand and a super regulated, institutional-friendly asset class on the other.
That's a great way to put it, exactly. You have the raw, almost primal energy of something like Hypurr, the immense pressure on conservative giants like Vanguard to finally join in. You have sophisticated hedge funds aping into things like Polymarket and then Grayscale, meticulously crafting the perfect compliant yield vehicle. And all of that innovation, all that capital movement is happening under the shadow of this potential regulatory rug pull that threatens the very DeFi infrastructure, enabling a lot of it.
So pulling it all together, what does this mean for you, the listener, trying to figure out how to navigate this incredibly complex and, frankly, volatile space?
Well, maybe we can leave you with this thought to chew on. It comes directly from that tension we've been discussing, right, from the sources. If you have major players like Grayscale successfully building these sort of legal walled gardens that offer nice, predictable yield, but those products perhaps only really thrive if regulators simultaneously clamp down hard on the riskier, but maybe higher reward, unregulated DeFi world, effectively pulling the rug. Then what path do you take? Is the future defined by chasing that institutional validation and regulated yield, even if it's in a more restricted environment? Or is it still about betting on the volatile, permissionless innovation that the government seems so intent on controlling? Where you land on that question, that's kind of defining the entire market right now.
That is definitely, yeah, massive food for thought, a really complex picture. Thank you for breaking down these tectonic shifts happening in the crypto world with us today.
My pleasure. Always fascinating to try and piece together these different movements.
And for everyone listening, you can follow NiftyNoon on X and Substack for those daily updates we dove into. Thanks for tuning in, and we'll catch you next time.